Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, August 10th, 2022. It's 9:48 Eastern Time as I'm starting the video, but what I'm going to do, this one isn't um, it's one of the more timely videos. What I want to do here is just kind of paint the bigger picture and tell you some of the things that have most certainly been factoring into my outlook for the markets, my trading, investing, and what that has to do is pretty much, and I'll speak a little more on this in a minute, is a positive feedback loop here with inflationary forces, the Fed and the stock market. They're all interrelated, and I feel like for quite a while now I've been just one or two steps ahead of this market on kind of predicting which way things would go. If you recall, last month we had an extremely hot CPI, took the market by shock. I said the market's overreacting. It's going to go the other way. Showed you my real-time commodity indicators. So we're going to real-time inflation indicators, and we're going to talk on that. So, I didn't speak much of it, but I did make mention yesterday, and I'll show you that post in a response to a member on the site that asked a question. And regarding the big spike in the futures today, that was everything I talked about a month ago today when the CPI number came out. Said it was, I called it a false print, and I just addressed the fact that the data is so lagged, and it amazes me because I don't typically turn on the financial media, watch TV, and I watch it, and they're not talking about this stuff. So here's where I'm going. If we can get a good pulse on inflation and stay a step or two ahead of the Fed, because that's what this market is all about. There are different points in time. Usually the Fed always has a big impact on the market, but the market is trading almost in lockstep now to what they think the Fed would do. So, again, pivot last month, and it said, look, the smart folks, smart money on Wall Street would realize that print was really a hotter than inflation is actually running, that there was a big abatement in June. I talked about that, but that just showed up now in this morning's numbers. And so you're seeing again, what I call the JCL, Johnny come lately, longs that want to buy right now. And basically what I'm trying to get at is they're trading on dated news. So I'm going to try to show you where I think nothing's changed on my outlook for the markets. I think we're very near, if not at, if we didn't put a top in, what was it, Friday, we hit that the initial tag of the 200 in the downtrend line. Like I said, we're very close, within 5%. So let me start here, and then I'll get into the charts, and again, just show you some things to watch, and we'll try to continue to stay ahead of the Fed. This is, before I get to this is a CRB. I'm going to get to this one in just one second here. Okay, this is where I wanted to start. So this is what we're doing here is really a hybrid of fundamental analysis. When I talk about inflationary forces, interest rate impact they'll have on the market, that is fundamental analysis. And of course, I marry that with technical analysis. That's what I do. So question yesterday, Randy, with the CPI being released tomorrow morning and expecting maybe a reflection of the drop in commodities we have seen since mid-June, that's what I spoke on. Does that put a dent in the short-term argument of the short trade on the Qs and IWM? And so my reply, great question, just in case you can't read it here on the video. Great question, something that I've already put some thought into. Scenario one, the abatement in inflationary pressures that I was harping on a month ago in the CPI and the media headlines were, and then my little quotations, erroneously scorching hot, along with the perceived pivot that would allow the Fed to be less hawkish or dovish. In other words, when the inflation forces come down, then they can start to back off their hawkish stance. So my scenario one was that has already been fully priced into the roughly 20% rally off the mid-June lows into NDX. Okay, so I'm still, and again, I'm right here between scenario one and two. I'll get to that in a second. Scenario two, we get a cooler than expected print, which I fully expected, or I didn't say I expect, I said a cooler than expected print on the CPI will be the catalyst for one last thrust higher, as much as up to but not, and this is important, not on a weekly closing basis, above my max bounce target of the 200-day simple moving average. That is only about 5% above where we're at right now, the 200-day simple moving average. I covered that quite a bit lately, so we're not going to jump there right now. And so scenario 3, I'm just wrong. Means we go up a lot more than that. Market goes on to see new highs or goes well above the 200-day simple moving average. Okay. Because in both scenarios 1 and 2 I make money. They're so close together. In other words, some highs, like sometimes I'll nail a high and I'll tell you I think that's the high, and I do a hard pivot. If let's say I'm long going any trade going into a resistance level, my final target, I close out the full long position and I go to a full short. That's a hard pivot. This is more of a soft pivot. Some tops are events, but most are processes, and that's what I'm treating this one as. And I've told you for the last couple of weeks I've been scaling into shorts, scaling out of longs. As of whatever it was, I think it was last Friday or whatever, I told you I closed out the last of my longs in 401ks, IRAs, and I even started then in some of those taking some short positions. So that's that. Now, again, it's kind of looking ahead. It's all about inflation. That's what the market is going. That's why you saw the huge pop today in the futures, because the fact that the market perceives that is the Fed can start of sort of let off the throttle. Not necessarily going to start tapping the brakes. Tapping the brakes is when they put raise rates, but at least they can take their foot off the accelerator right now. But again, how much of that has been priced in? You have to remember the stock market is forward looking. The old rule of thumb, it looks out 6 to 9 months ahead. Lately, but that's a little different in a bear market. Bear markets, the fundamentals, the macro, the fundamental landscape is changing so rapidly. Analysts, if you guys even ever watch TV or read the paper, and these analysts it's almost comical. They'll come in after a stock is already down 50% and then get plunged down another 20% on a bad earnings meet. Then all the downgrades come. They start putting sell ratings where they were all buy ratings at the high. So they don't know. Fundamental analysis just does not work in this type of environment with the macros changing so fast. Technicals, I've said it time and time again, are the much more accurate guide, but when you can marry the two together, and with the fundamentals, you got to be in front of it. If you wait for the headlines, if you wait for them to tell you that inflation is cooled, it is dated information. The pros, the smart money on Wall Street, they knew about it. They've already traded that trade, and at that point, like today's pop, I don't know. I can't tell you if it's a hard sell, this pop this morning, but I can assure you there are quite a bit of pros that are selling into this. And if you just look at again where the NASDAQ 100 has come from roughly off the lows there, roughly again 21% or so. All right, so back to that. Okay, my thoughts, where I think we're at, and now this is what it's all about. This again, I don't hear this being talked about. Maybe it is. I live in my own bubble. I very much try to avoid analysis from others. I'll kind of turn on the TV and I'll read the papers to get the pulse of what the general public and the general consensus is thinking. And the public tends to be swayed by whatever the media is feeding them that day. And the media also, their job is to report news. It's not, they'll march people out to make predictions, but they're reporting news. And again, news is hindsight. By the time you read about it, it's most often fully or mostly priced in to whatever security it affects. So here we go. This is the CRB. There's a lot of different commodity indexes. This is just one of many that I have here, and I'm going to show you what I'm looking at here. Let me just change my color on my trend line here, something that stands out. Okay, we're going back, gosh, this is all the way to 2002. And back then, commodities were in a bull market that ended back in 2008. So commodities usually run in line with the stock market. That's been the historical trend for decades. But there was a disconnect. So and they were running with the stock market. Remember, the stock market, the last big bear market, or to me, the last real bear market started when the markets topped in October of 2007. That's when right here when the stock market topped, and then we had the great bear market that ended in March of '09 was the official end date, and that's when that was that. And you can see commodities were in a bull market. So here's a couple things I want to talk about. Number one, I talk about divergences. Divergences are a big part of my trading and investing. So these are the divergences. This was a bull run. This was a divergent high right here. You had negative divergence at that point. But what happened? You had a correction, but it was very minor, a slight correction, more so in time than price. Then you had another divergent high right here, big divergence. And again, what happened? Minor little correction. So where I'm going with this, in a bull market, negative divergences often either don't play out at all, they get burned through, or they play out for a relatively minor correction. You want to look for bullish divergence, divergent lows. Here was a divergent low right there. See that? Small but mighty. That's all it takes. And then you had a huge spike. And this is big. I use log scaling. I can tell you that's in percentage moves. That was a big run right there. And that was the blow off top. And that's kind of what a blow off top looks like right there. That you go parabolic, and that was the end. So where am I going? This right here, that blow off top in 2008 after the stock market had peaked, marked the end of a bull market in commodities and the beginning of a bear market. A pretty dang powerful bear market, and an unusual one because this bear market in commodities did not end until the COVID lows back in March of '09 or April. And it was unusual because it was a bear market in commodities while the stock market was in one of the strongest bull markets in history. Yeah, the stock market fell there too, but all while here the stock market was pumped up to new all-time highs due to the Fed. So here's where I'm going. We ended, and I've said this many times. I said it back then. I thought it would end, and then we got one check mark after another. We ended a multi-year what is that? Gosh, 12 years or so bear market in commodities. And at this point, I suspected, and then it was confirmed and confirmed again and again and again. We started a new bull market in commodities. That bull market has only just begun. This is really pretty much, to me, the first leg up. There are divergences, and there have been, but here's why I believe it's a bull market and why I believe it's early stages. Well, plain and simply put, a bullish trend or an uptrend or a bull market is a security making a series of lower highs and higher highs, right? Now, that's a bull trend. But what makes a bull market is when you start taking out the previous bear market lows. So we took out that major reaction high, then we took out this one, then we took out this one, then we took out this one, and then recently we took out this one. At this point, we've retraced almost the entire bear market. So you say whatever you want. Maybe this will prove to be just a little mini bull. I believe it's the start of a much longer one. Now, there are divergences, and you knew me. I cooled down on commodities, started shorting a few back here. We had quite a few negative divergences. But again, the negative divergences in a bull trend typically only play out for small correction. There is a trend line there, and we could get a deeper pullback. But odds say that we're going to keep going up. And now what I said in the beginning of the video, I think what we have here and what we'll see going forward, again, this is my job to try to predict, not talk about what happened like so many other sources do. Oh, the market did this and that. So my prediction is going forward, and I've seen it so far, it's developing, we're at a positive feedback loop. So, okay, so let's take today. Inflation data cooled. Stock market's rallying. Why? Because the Fed can say, oh yeah, look, we did it. We pulled it off. We engineered a soft landing. We've put a check on commodity inflationary forces. They've been abating. Well, as soon as that happens, you're going to see commodities rally. I think the smart money is going to say, oh, okay, we're going to see lower rates, so therefore we're going to put money into commodities, which is an inflationary trade, and you're going to see inflation pick right back up. So I think at any point where you see the Fed start to, or even the markets infer that the Fed will start to go a little more dovish, a little less hawkish, let's just say, then I think you're going to see investors flock to and buy, especially smart money commodities, and the commodity bull will rage on. And so you're going to see these little abatements in inflationary forces. Again, this one I talked about last month when they said it was the hottest print in a while, and I said no, it was wrong. It was we saw the biggest drop in months in the month of June, biggest drop really since this inflation thing started. And so that's it. So you just got to look ahead. Let's keep an eye on the commodity charts, and that's going to put you one step ahead of the Fed. And so every time we see the market's going to rally on the expectation that the Fed can maybe let off the throttle a little bit, and as soon as it does, that's inflationary too. Rising stock prices in themselves are inflationary, and of course, then I think you'll see money come back into commodities, and we'll continue to trade accordingly, factor that in. And so, where are we going? Well, if it's a new bull market, no, the next thing we've got to do is take out this high and then that high. And again, there's just a lot of evidence in the charts that tell me that commodity prices, and I'm not talking today, tomorrow, next week, I'm talking in the coming months to coming years, that I think they're going higher. I just had a order fill. I'm gonna just do an update there. Speaking of commodities, I just had my last my lumber futures sold. I told you yesterday during the video I stopped it to take half the position off. So yep, there it is. Yep. I had a sold limit order right here. So that one's at resistance. Nice trade so far. Just in the last what is this, week or so? This is a 60-minute chart. 25% rally in lumber. So congrats, caught it. For the time being, I'm out because that's pretty significant resistance. And again, this is what happens, So, well, you had a bull flag here too. You guys see that little bull flag I had on there? Popped it, and that could take us up a little higher. You can trail stops. Problem with lumber futures is they're pretty big fat spread between the bid and ask. They're fairly illiquid, and as I mentioned, there's that new contract too. If you guys want to trade the smaller, what I think it's LBS, but either way, I'll do an update later. I didn't want to digress. I just had the order fill. Okay, so I'm going to just spend the rest of the video very quickly rifling through various commodities. I'll use the ETFs. I know a lot of you out there don't trade futures. I understand that, so I'll go over the ETNs. Plus, I have a watch list. It's easier for me to click through on commodity ETN and ETFs. Before I do that, I also know a lot of you could care less about trading commodities. I like it. Number one, I like it because it's diversified. There's days that my equity, if I'm trading the indexes or have a basket of individual stocks, and whether I'm bullish and long or bearish and short, not every day the market's going to go my way, and that's nice because the commodities are uncorrelated assets, part of asset allocation and diversification. So the days that my stock index futures are down, or positions going against me, my gold is up, or my wheat, or my corn, or crude oil, or natural gas, or whatever it is. But there's where we're at on the Qs. Nothing's changed since the other day. There was last week, what was that, Monday's high? Yeah, it was Monday that we tagged the 200-day in the downtrend line, and we're still below it. And again, there's my max bounce target, and to measure it out for you from where we're at right now. Let me zoom in here. It's roughly, depending if and when we get there, about five and a half, depends again when we get there. And I'm made clear that I think my preference is to wait for a solid weekly close, not intra-week. If they run at it, they're probably going to pop it intra-week. You almost have to expect stop raids and false breakouts and whipsaws in this day and age, with all the algos knowing exactly where the stops are placed. So that's it. Let's look at these commodity ETFs and ETNs in no particular order. I'm just clicking through my watch list. And I'm going to start, I'm just probably focus on the daily time frame. Every now and then I might loop over to the weekly, and it's the same thing. These guys are moving together, most of these commodities. I just want to go back to that CRB real quick and show you one other thing I'm looking at on it, again, because this is a broad-based commodity tracking index here. One of the things to note is the PPO is well above the zero line right there. There's the zero line, there's the PPO. That's indicative of bull market action. And in a bull market, you come down, you test the zero line, and that's often where you hold. You get a correction, you go underneath. There was a decent correction. Bear markets, and that's what we entered here. You get down below, and there's a trade of a bear market. You spend a lot of time with the PPO below there. So this has all been nothing but bull market action. We're still above there, and we're coming up to back test it. So Another thing you do, you spend most of your time on the RSI above the 50 level. That's in the middle there in bull markets, and you spend a lot of time below that 50 level in a bear market. So this has been nothing but bull market, indicative of early stage. Again, to me, that's important. Early stage bull market action. We can have some correct, and we will. We'll have corrections along the way, but like I said, positive feedback loop. Commodities correct. That's an abatement of inflationary forces. You'll see the market rally. The Fed can back off. But when you start to see, and this is what we're going to be watching, that's why I'm doing this video, watch these commodities. If you don't have time to look at them all, pick a broad-based commodity index or ETF, which I'm about to get to in a second. DJP is one of my favorites, but there's cotton, BAL, and you know you can just turn off all the lines and see here's a commodity clearly in an uptrend. And you know, cotton, it's not the biggest mover of the CPI, but you know it's you know a lot of clothes and everything else made from that. Gasoline, this is a big one. UGA. Tracks the price of unleaded gasoline, obviously in a bull trend. You know, put in a divergent high. There was a nice sell signal breakdown, but you came down here and you hit support about close to it, 53.61. You know, and you'll watch this because everything I'm saying can go the other way. So if we're going to have a bigger than expected correction in commodities, and I'll stay flexible. We start breaking support. Remember, I did have some additional downside targets in gasoline, crude oil, natural gas, but they're not going straight there. There's been plenty of counter trend rallies along the way, and as of now, this is it. This might be it. This might be all we get for now. Let me just continue on. UNG had a big correction, but boom, natural gas right back up there, right near the highs. Pulled back recently. And again, bigger picture is this appears to be early stage bull market action. LD, this tracks lead, and you know it was going up, like everything. And again, these commodities, a lot of them put in divergent highs. They had a hell of a run, and they corrected. And the $1,000,000 question is that correction over, or is this bull run over? I think the correction's over in a lot of these, and we're already seeing them going up. So here's back to where I was talking about earlier. This is where I laughed at the hot numbers last month. This was the June. This was the month of June right here, and they all look like this. You can go to crude oil, natural gas. That's when we came in with last month, not the number that came out today, the one that came out a month ago. Hottest number, blew away expectations, and I've made the case that guess what? No, they were wrong. That this big drop in commodities that happened in the month of June was just now reflected in the month of July. But look what happened. Look, everything's gone up since then. So again, you're about a month behind, or they are, on these numbers that the you know the Fed and others are looking at. Aluminum. I posted this one as a bullish setup recently, right here on that $49 support. Not really gone anywhere, but it stopped. It had to put in a divergent low. It's gone up a little bit, but it stopped going down. So this whole abatement in inflationary forces, I believe, was transitory. I think it was just a correction in a bull market, and we're going to, especially now, you know, the market's inferring that the Fed is going to back off a little bit, maybe not do another 75 basis points at the next meeting, maybe only 50, maybe even 25. That's the hopium right now pumping through the markets, and I think the expectation from what I heard this morning. But you start to see this go up. And then, of course, what I don't have here in wage, Fed looks at that. That's a big one too. We're definitely seeing wage inflation, and that's I think that one's more persistent. So I'm going to draw one more line before I move on there. I think, yeah, that's another trend line I should have had there. DJP, one of my favorite broad-based commodity ETNs. It's got it all: natural gas, gold, crude oil, Brent, West Texas crude, Brent crude, soybeans, corn, copper, silver, gas, oil futures, soybeans, everything. You got it all. And again, just look at it longer term. Bull market ended back in '08. Big bear market early stage initial bull market leg up is what it appears to be. So I think we're looking at a persistent inflationary forces. I think we entered a new secular trend of rising interest rates and rising commodity prices, and therefore every time there's going to be a little abatement, the Fed thinks they can back off. Nope, they're going to get checked, and so you're going to see that's going to be the zigs and zags of the commodities arena as well as the stock market. We're going to trade those accordingly, and we're going to again try to get in front of it. So where do we go from here? Well, as I mentioned earlier on the CRB, this PPO is in bull market territory and it's coming in back testing here. At my max pullback target right now would be that $31 level there. So, and that would, if we get that, another leg down and maybe crude oil and nat gas going to hit those max downside targets that I have, yeah, that drop in commodities will most likely lead to that last leg up, one more thrust up, maybe, as I said, maybe another 5% or so in the stock market. But I wouldn't bank on it. I'd rather ride it out, continue to scale in short, because if that doesn't happen and we do this, then and we hold here, then you're going to see a pretty strong move down. And this will coincide, I believe, with my next leg down in my stock market. Nothing, I've not waffled, and it's not that I'm being stubborn. I want to find a reason to get off my initial, to find a reason why I might be wrong and why I should change my longer term outlook. And please don't ever confuse my long-term outlook with my near-term or short-term. I know I confuse the heck out of people telling you I've reversed gold or I reverse stock market shorts. I wear multiple hats. I wear a day trader, active swing trader hat. I wear a trend trader hat and an investor hat. I've got kids' college plans, Coverdell educational savings accounts. They let you trade unlike 529s. I've got IRAs, 401ks. Those are the longer term funds. And then of course my trading account, and that's short term stuff. So, but this is QQQ. We were started shorted here on that break, that one there, swung it all the way down, and had plenty of trades long and short along the way. Hit my third target, that was the last pivot, and we ran up to my max bounce target, my initial, swing trend targets, which is and still is that downtrend line and 40-week, aka 200-day moving average. And so this is still, we already hit my third target, and so that we hit it once. We'll probably get one more reaction if we get there, and then come on down to my fourth and final, what I'm calling initial bear market target. Let's not go too far off that, meaning a big tradable rally off there, but I'll address it at the time if and when we hit that, and talk about some any additional downside we might get after what should be a very nice tradable rally if we get down there. Okay, just back to my commodities. We're almost finished. JJG, grains. This is three of them. You've got corn, soybeans, and wheat. So I've thrown out corn and wheat as trade ideas recently. Obviously, to be bullish, those two to be bullish, they're all alternative. These are the grains. That's why JJG tracks them all. That's what it's called, the grain ETN. And like everything, nothing goes up forever. You had a nice bull run. You get a little ahead of yourself and look for these. This is what we call a buying climax, a blow off top. And I don't think it marked the end of the run in commodities, but at least the near term. There was another one right there. See that? When you start going parabolic and you see a big surge in volume, this is just I call them Johnny come latelys. They didn't want to buy wheat here and the grains here. They didn't want to buy it there. They didn't want to buy it there. There were multiple opportunities to buy it. This is when everyone started. The general public, no offense, you put me in that group if you want. They call it the dumb money, the smart money being institutional professional traders. This is when dumb money says, oh gosh, I need to buy commodities because they've been going up, not because the charts are constructive and they've been going down. This is where we were buying back here initially, that bullish falling wedge breakout back test. And so you get these blow-off tops, but in a bull market they're temporary, and it was a heck of a correction, and boom, you came back to support. So that's why we're long and bullish the grains right now. So and this probably was, you can see nice divergence. That's what you want to look for in a bull market. Get these little divergent lows, and that's usually the catalyst to the run to the next highs. So there's JJG, GSG, another broad-based commodity index, 54% energy, 20% ag, 12% industrial metals, 7.5 livestock, and about 5.5 precious metals. And you can see this one. Here's a case to maybe step in and buy commodities. There's a primary uptrend line. We put in this little wedge here, divergent high. Nothing goes up forever, right? And you had a healthy correction. And this all here was in large part of the fundamental reason I've been bullish for the last 2 months. And but I think again, now that the masses have recognized that and see that, it's probably over, or at least most of it. And we bounce and we go up, and then inflation trade rages on, and then the markets realize that, and they realize the Fed didn't engineer that perfect soft landing. They just just coincidence, really. They raised rates, and I think you saw profit taking in the commodities because of that as well. But guys, it all ties together. It's like the fundamentals and the charts. It never fails to amaze me. They are intertwined. They work together. So it's kind of like the chicken and the egg thing. But again, the charts are going to be a much better and much more accurate guide, especially for your market timing purposes. Corn was thrown out here. T1's already hit. I've also showed that, and there's another one there. Nice uptrend line right there, but it got ahead of itself, put in a divergent high, a little wedge, broke down, had a correction, but ended with this bullish, aka positive divergence, moved up, and will probably continue on up. JJS, that's soft commodity, ETN right there, tracks the basket of soft commodities, divergent high, correction, probably continue on. GCC, Wisdom Tree, commodity, continuous commodity, and just another broad-based commodity ETF came down to support. You look at it from a weekly chart here, and there was really nice. That was resistance, and we pulled back to it, overshot it briefly. There was a lot of, this is what I call momentum fueled overshoot. You had a lot of downward velocity or momentum coming into that level, but look, we overshot it briefly and snapped back, and we're on it now. So it's holding that 2266 support in a bull market with the PPO starting to turn back up at the zero line. And worst case scenario, if we have a little more downside, there's still plenty of big support here, and that would still very much keep us in bull market. On the charts if that happens, but this is probably where they're going to step in and buy, especially now with the perceived pivot in the Fed based on today's abatement in the CPI numbers. I think you're going to see institutional investors, smart money, coming in and starting to get back into commodities here. DBA, agricultural ETF, look at that. Bull run right here, pull back to support. Can't ask for much better. Again, a lot of these had divergences at the recent highs, so the pullback was to be expected. But in a bull market, you're going to get a correction. It pretty much met its measured target. You get a wedge type pattern like that. Just take the widest part of the wedge, which I'm just ballparking there. Add it to where it breaks down. It gives you a measured target. So that looks like. We'll continue on there. SGG, sugar. Let me get back to the daily chart. Look at sugar. Sugar has been bull run, correction. I always say securities can correct in one of two ways. They can correct in price and or time. This has been a correction in time. So sugar's basing here. If it's a bull market, you're probably going to have an upside break. Even if you get a downside break, it'll probably be a false breakdown. If not, then hey, I'm wrong. Maybe the inflation trade is over. Maybe commodities, the bull run is over. And if so, then as and if each of these previous reaction lows are taken out, well, it starts to give little check marks for the bearish case. But as of now, that's not the way I see it. Coffee, divergent low after that correction, a little wedge break there. And again, so I just think this is just a bull market correction. We had a hell of a run in a lot of these commodities, and they've corrected. And I think soon we'll start the next leg up in the commodities bull. Great commodities bull. Gold, I gave you an update today on that. Hit that target that I had for you on the GC, the gold futures. NIB, cocoa. Cocoa took out this trend line but also fell down here to this 23.61 support, and more importantly, put in this divergent low right here, positive divergence. So looks like that one's going up from here. Oil, I already covered oil, coal, JCC, copper. I threw out copper recently as a trade idea. I threw it out on the futures as well for you. Let's check on those. I haven't updated that one in a while. That was I've got it here somewhere. Bear with me, or I'll have to pause the video. There it is. HG. Yep, that's it. HG, copper futures, you have this T2 was hit. So this one was thrown out somewhere in here before we even broke out. We hit my first target. I can't remember if first target was a downtrend line or this price level. Moved up. But look, it's put in divergent high right here. Although it's been diverging, it keeps moving up. So we're between T2. We hit T2. We could continue on to T3, and it may burn through these divergences. I don't have a position right now, and I'm kind of neutral on it. Wouldn't surprise me to see it go up there, but with these divergences, you got to be careful. It could correct, come back down there, that 339-ish level, but still have additional upside targets on copper. A few more. I know the video is getting long. Cane is sugar. I already covered SGG. It's just there's two different sugar ETNs out there, Cane and SGG. But you can see right here, really that's where that line should be, that previous low, 873. So there it is. Corrected, pulled back to support. Was an objective long here. And you can buy it down to 873 with a stop somewhat below. USO crude oil, I still have additional downside targets, but you know, I won't be shocked if they're not hit. It's still what I favor, but that's those swing targets. I've covered it many times. 56.80 price plus the uptrend line. If we get there and the charts are constructive, that'll be a nice time to cover any swing or trend shorts and reverse to longs. Copper, I think I already covered copper. No, was it copper I covered? Oh, there it is. Yeah, that one was also mentioned on 1913 support. And you had a nice sharp downtrend line. I might have given that one to you on the 60-minute chart. Let me see. Nope, maybe not. Maybe it was the copper futures. And I'll just end it here with wheat. Video's gone long enough. You get the point. I don't want to beat a dead horse, but you know, remember commodities. You know, each and every one of these. Some to a larger degree than others have an impact on inflation, especially the energy, oil, natural gas. That's probably the largest, but then you have food, you know, especially the grains. That's probably one of your biggest. So there's that. Here's the month of June. Let me just zoom in here. Remember, wheat's a buy here. You have positive divergence. I've given you the chart of wheat futures as well recently. You pull back to your bull market primary uptrend line. Each and every time you pull back to that level, it was a catalyst for the next leg up. And let me just flip back to the long-term chart. So there it is. See, wheat has been, like all commodities, just came out of a pretty long and powerful bear market, and this at this point in time appears to be nothing but early stage bull market action. Things got a little ahead of itself. You know, Russia, Ukraine caused a surge in wheat prices. They came back down, and we'll probably continue on up. And look, just to get back on all these commodities, not just wheat, just to get back to where we were back in 2012. Remember, please remember this. We are in, by far, the hottest inflationary environment in over 40 years. We haven't had inflation like this since the late 70s, peaked out in the early 80s. And so is it that hard to believe that wheat and a lot of these other commodities and oil and everything else are going to go back to where they were back in, you know, this is charts only going back here to 2012. Remember, we peaked in 08. So here, let me just do GJP. What's that one? I think we can go back that far. Yeah. So is it that hard to believe that commodities can just simply get back to where they were in 2008 when inflation was a fraction of where it is today? Inflation was tame and under control as it's been for 40 years. So by that logic, we should be well above where we were in 2008. right? So there's again, this is my case for this most likely being early stage bull market action. Most people just they can't see out that far. All they can say is, wow, commodities have run up 162%. Well, that's just a basic, a simple partial retracement of the previous from the bear market. From right now, we haven't even retraced 50%. Again, this is a broad-based commodity ETF, and we have not even retraced 50% of the previous bull market, bear market, I should say, or bull market highs. So we go up to the 61.8 fib, and that means we have another 45% upside, and that means we've only done a typical 61.8% retracement of the previous bear market, and that would still give us another surge of 45% in commodity prices. So there you have it. And like I said, I think it's going to be a seesaw with this positive feedback thing where you get these little abatements, market rallies, and those will be bear market rallies, thinking the Fed can get easy again. And then the next reality check's going to set in, and it'll just be probably like this for the foreseeable future. Let's just say at least the next year or so. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.